The day after we got that hotter than expected 1.3% increase in June consumer prices, 9.1% year over year, the next day we also got a hotter than expected increase in June producer prices. The markets had been expecting producer prices to rise by 0.8% in June, and that would have matched the 0.8% increase in the prior month. I mean, the dollar has been on a tear. Once again, this week, the dollar index rose from 107 to 108. And in fact, the intra-week high was 109.3. So the dollar is surging. It's near a 20-year high against the euro. It's at a 24-year high against the Japanese yen. And it's because the dollar is so strong that import prices are only up by 10.7% on the year, because if the dollar wasn't so strong, import prices would have gone up a lot more than that, and that would have spilled over into the CPI. So, but for the strong dollar, we would have much higher inflation numbers than the ones we're dealing with. Now, it's obviously working in reverse in Europe and Japan. Whatever they're importing from the United States, and obviously they don't import as much from us as we import from them. But the question is, why would the dollar be so strong internationally when it's so weak domestically? Because after all, the US dollar is only legal tender here in America. And so the international exchange value of the dollar should reflect its purchasing power in America, where it's legal tender. In fact, if you go back to the 1970s, that's the inflationary decade that we're now reliving, only worse. But if you go back to the 1970s, the dollar was very weak. The dollar lost about 70% of its value during that decade.
Here in New Jersey, 10% of the workforce is unemployed. Across the nation, the average is 8%.
Also, you have to remember that the balance of trade position of the United States during the 1970s was far superior to what it is today. I mean, in the 70s, we were still running trade surpluses. We still manufactured all sorts of stuff that the rest of the world needed dollars to buy. And in fact, during the 1970s, the US was still the world's biggest creditor nation. Now, clearly, that's better than zero, but when you have inflation at 9%, that's still a negative real rate of 6.5%. So not an inflation hedge there. If even after your yield, if you could even get 2.5%, you're still losing 6.5% of your money. But that is not the dynamic that Europeans are looking at, or the Japanese. Gold pays no yield. In fact, a lot of people have to pay to have their gold stored for them. So right now, the dollar is stealing gold's luster. I mean, for a while, it was Bitcoin that everybody wanted instead of gold, but now it's the dollar that everybody wants instead of gold. Now, eventually, people are going to figure out that they don't want the dollar, just like a lot of them figured out they don't want Bitcoin. There is ultimately going to be a rush into gold. As I've been saying, gold will be the last safe haven standing, because it's the only true safe haven. And again, going back to the decade of the 1970s, which is the only real blueprint we have for what we're going to experience, because this decade will be more highly inflationary than that one. I mean, clearly, the recession is going to be much deeper when interest rates are higher. And clearly, the layoffs that have already begun are going to massively accelerate as the recession gets worse. In fact, look at the industrial production numbers that came out for June. That was an unexpected decline. The consensus was for a 0.1% increase, and instead we had a 0.2% decrease. Now, the consumer is completely wrong. Inflation is going to get much worse. The fact that the consumer doesn't understand that doesn't change that.
This is a disappointing report. Despite 5 interest rate hikes from the Federal Reserve this year, inflation remains stubbornly, persistently high.
But you have a lot of people who still believe falsely that inflation is a function of expectations, that it's the expectation of inflation that causes inflation. And a lot of this thinking is coming from government to try to shift the blame away from themselves to the public. The idea is that if consumers think there's going to be inflation, they will behave differently. They will stock up on goods now to front run price increases, accelerating demand. They will demand raises from their employers, and it will help push up wages and a wage price spiral. So a lot of this is expectation. Same with businesses. If businesses expect inflation, well, they'll raise their prices in anticipation of the expectation of inflation. And so the government tries to claim that this whole thing is psychological. It becomes a self-perpetuating process, that the government is just an innocent bystander, that all the money they're printing is irrelevant. Now, while the Fed has been making some progress with its rate hikes, albeit slow progress, and obviously if we get this 100 basis point rate hike this month and they're at 2.5%, they will have made some considerable progress in building a distance between zero and where the Fed funds rate is. But one place they haven't made any progress at all, really, is in shrinking the balance sheet. Now, Biden had done something by executive order to that effect, but now it's going to be codified into law that the minimum wage for anybody contracting with the U.S. government is $15 an hour. Now, this is also inflationary. Just like the $800 billion in deficit spending is inflationary. It's either inflationary because the Fed has to print the money, or because there's crowding out. If the Fed doesn't buy the bonds, somebody in the private sector does. And if they're buying treasuries, they're not loaning money to corporations. And so capital investment is going to have to be crowded out in order to make room for the deficits to finance defense. And that means higher prices. We're producing less stuff. We need to produce more stuff to help combat upward pressure on prices. Not less stuff, but bigger government deficit spending crowds out private investment. In fact, not even the Republicans are willing to level with the American public about what it's going to take to fight inflation. Sure, they're willing to blame it all on Biden, but they're not willing to accept any of the responsibility or acknowledge any of the bitter tasting medicine that needs to be swallowed, because we had huge deficit spending under Donald Trump too. It's not that we just started doing it under Biden. No, I mean, Biden's just doing more of it. But both Democrats and Republicans have been deficit spending. In fact, you have a lot of Republicans who want this extra $800 billion defense spending bill. They're not saying, oh, we can't spend this money because it's inflationary. No, they don't care about the budget deficits. They care about the defense contractors. They want their political support. They couldn't care about the budget deficits. They couldn't care about inflation. And that was true long before Biden became president. People need to lose the wrong jobs before they can get the right jobs. Now, how much time is going to transpire between losing the wrong job and getting the right job? I don't know. Obviously, the government can elongate that time by interfering with the economy and slowing down the process. But to think that we can just go from where we are to where we need to be without a recession is pie in the sky fantasy. And for Art Laffer to try to claim that there's a solution here, a painless solution where we magically avoid a recession. But the only reason we're going to have a recession is because these idiots at the Federal Reserve don't know what they're doing. They don't know what they're doing, but we need a recession in order to fix all the mistakes that they helped the economy to create. But what actually made it worse is not only did Art Laffer think that we could just let interest rates rise all the way up there and it's not going to have a problem, not going to cause a recession, but his other solution for the current inflation problem was tax cuts.